Back when I was a lender, it probably took me a year or two till I fully understood all the intricacies of an FHA loan. For instance, did you know the FHA loan is actually 5.25% down, not 3.5%? I'll explain why. Also, if you're in a community property state, your spouse's debts are added to the loan, whether they're on the loan or not. And also, there's actually a way to get your earnest money back even after the option period due to a clause in the FHA loan. We're going to cover those details and, of course, get into the basics like the updated 2024 loan limits, house hacking, and how the FHA self sufficiency test works. Very important. We're going to cover the 203K rehab loan, the appraisals, of course, credit, and also get into the history of the FHA itself because I think that's led to a lot of misperceptions that are out there. By the way, if this is your first time hearing my voice, my name is David. I have a background as a mortgage underwriter, a mortgage lender, and a realtor. I've also purchased multiple homes myself, but most importantly, I've helped hundreds of people just like you buy their first home in real life. I don't just talk about it on the internet. Let's go get those keys. Welcome back to House Rich, the first time homebuyer show, where we provide you actionable steps in layman terms to buy your first home. Let's get right into it. The FHA stands for the Federal Housing Administration. It was an agency established to help folks in a lower income bracket and with credit challenges purchase their first home. But I think that's one of those misperceptions that's stuck with the program still to this day because one, it's not just for people with bad credit, it's great for house hacking, which we'll talk about as well. But also, it has the highest down payment now of any loan program out there. Think about it. NACA is zero, VA is zero, USDA is zero, conventional is 3% down for a first time home buyer, and FHA is 3.5%. But as I mentioned in the intro, it's actually 5.25%. Yeah. Important to note though, the FHA does not give out the loans, they just insure them. You'll get the loans from your local bank, lender, etc. But because they insure the loans, they set the minimum guidelines. So everything I talk about in this episode are the minimums. Lenders can set overlays or put overlays on top of the guidelines to make them more stringent to mitigate the perceived risk that they have. Think about it like this, like the federal government sets the minimum wage at $7.50. Of course, an employer can give you more money per hour, $25 an hour, $50 an hour, etc. But they cannot go below that 750. So kind of like think about minimum wage when I'm talking about the overlays that lenders may put on top of these guidelines. So let's get into it by talking about who's eligible in the first place. First and foremost, you cannot use an FHA loan unless you plan to live in that property as your primary residence for 1 year. There's no exception at all to that rule. Anybody telling you otherwise is either stupid or lying to you. Ask that person to show you where in writing it says that you can use an FHA loan for a vacation property or an investment property. That guideline does not exist. Now, it does not have to be the first property you've ever purchased because if you've not owned a home in the last 3 years, you're still eligible as a first time home buyer to use an FHA loan. But also, if you've purchased a property but have not lived there for the last 3 years, you are still eligible to use an FHA loan. For instance, you bought a property 4 years ago, stayed in that property for a year, and now you rent it out, you can still use another FHA loan. I said at the beginning you have to plan for it to be your residence for 1 year. There are some exceptions if things come up. For instance, you use an FHA loan, you've been there for 4 months, and then you get a new job and you're relocated across the country or really more than 100 miles from your primary residence. You can use another FHA loan, or if you get divorced and now you're no longer in the property, you can use an FHA loan. Or if you're a co-signer on the loan, there are a couple other exceptions. I'm not going to get into all of them, so you don't have to worry about trying to run the play on the FHA loan. Just focus on the basics for now. So let's talk about the credit basics. You can get an FHA loan with a 500 credit score as long as you can put down 10%. When you hear about that 3.5%, that is at a 580 credit score and above. Now, very important because I talked about overlays at the beginning. Most lenders are going to see you around a 620 credit score to be eligible for an FHA loan. But of course, there are lenders that will go down to the minimum guidelines that the FHA has put in place. But please believe you will get hammered on that interest rate. So like when you look online and you're like, hey, A 7% may be the average interest rate for an FHA loan or whatever it is at that time. Well, if you got a 580 credit score, you're not getting that 7%. You're probably in the 8.5% range. Same thing at the 500. You're going to be paying for that risk that the lender's taking on by you having a lower credit score by paying a much higher interest rate. So if you're looking or you're working on your credit, try to strive for at least a 620, 640 credit score so you're not getting hammered for being under that 620 threshold. Now, as I mentioned, the FHA loan is more forgiving when it comes to issues with credit such as medical debt and collections. For the most part, the FHA does not care about medical debt. They don't care about medical collections, but they do care about collections if they're over $2,000. Let me read this to you right from the FHA guideline. The FHA does not require collection accounts to be paid off as a condition of a mortgage approval. However, the FHA does recognize that collection efforts by creditors for unpaid collections could affect the borrower's ability to repay the mortgage. To mitigate this risk, the FHA is requiring a capacity analysis of collection accounts with an aggregate balance equal to or greater than $2,000. So essentially, most likely you'll need a payment plan in place, hard to say, if you have debt over $2,000. And that's an actual payment plan in place with the creditor, not just a plan you have in your head to say, hey, I'm going to pay off, a couple $100 a month. So just something to note when it comes to debt. Here are some other guidelines when it comes to credit issues. If you had a deed in lieu of foreclosure, there's a 3-year wait before you can get an FHA loan. For a bankruptcy, there's a 2-year wait. And for IRS liens, there is a 3-year wait. Now, who has the better interest rate? Is it conventional or FHA? It really depends on the lender, but typically your FHA loan is going to have a better primary rate than a conventional loan. I say primary because there's some things you need to factor into that interest rate when it comes to an FHA loan. So let's get to that 5.25% down payment. With an FHA loan, you put down 3.5% at closing for the down payment, but also there's a 1.75% upfront funding fee due at closing as well. Now, you either come out of pocket, but most folks don't come out of pocket, which is why you've never heard of this, or you can finance it into the loan, meaning add it on top of the loan. So let's say you have somehow you find a home that's $103,600 and change. After 3.5% down, that's a $100,000 loan amount. Well, with an upfront funding fee, you have to pay another $1,750. So now instead of your loan amount being $100,000, it's $100,000 plus $1,750. But wait, there's more. You also have to factor in your consideration for mortgage insurance. Now, with an FHA loan or a conventional loan, if you put down less than 20%, you're going to pay mortgage insurance. However, with an FHA loan, that mortgage insurance stays on the loan forever. With one exception, if you put down 10% initially when you buy the home. Let's be honest, you're probably using an FHA loan because you don't have the 10% to put down. If you have the 10% now, you're probably going to go conventional in the first place. The only way to drop the mortgage insurance is to refinance into a conventional loan. So let's run through a real life scenario. So let's say you're looking at 2 loan options. You're like, man, this FHA loan, I can get a 6.25%, but with this conventional loan, my interest rate is going to be a 6.5%. You're looking at a $400,000 home. With the conventional loan, your payment's going to be $2,528. With the FHA loan, it's going to be $2,463. That's your principal and interest payment. So that's like a $65 difference between the 2 loan amounts. That's pretty significant. That's like gas for the month, or that's a bill. And that comes out to like $780 a month. So you may be thinking, man, home run, let me go the FHA route. But remember, with a conventional loan, you can drop the mortgage insurance once your loan to value ratio reaches 80%, meaning that's through either appreciation, paying down the loan amount, or a combination of the two. Also of note, and we'll get into this in the conventional loan episode, if you say nothing to the lender, your mortgage insurance actually doesn't drop off until 78%. But back to the FHA loan. So now, if you have an 80% LTV with the FHA loan, the only way to drop it is to refinance it into a conventional loan. And refinances are not free. They're typically a couple $1,000s. So let's say you have the opportunity to refinance you got to pay like $4,000 out of pocket at closing, or once again, you can refinance those closing costs into the loan. So once again, you're still tacking money on top of your principal balance. But as we kind of see this year, there's not always a guarantee that you can refinance. Like if you bought a home at the beginning of the year, well, let's say rates were like 4.5%, and right now rates are 7.5%. It would make no sense for you to refinance, even if it meant dropping the mortgage insurance, because your rate's going to jump up 3%. So you may be stuck with that FHA mortgage insurance for years and years and years to go in the future. So once again, do that math as well, or have your lender do that math to see what may make sense long term, even if your FHA rate is lower than the conventional loan. Now, the moment you've all been waiting for, the 2024 FHA loan limits going into effect on January 1st. For a single family property, the new amount is $498,257. For a duplex, it is $637,950. Triplex, $771,125. And for that magical fourplex everyone likes to talk about, it is $958,350. Now, if you're sitting like in LA or New York or someplace else and you're like, man, there are no $498,000 homes anywhere, you may be in a high cost of living area. In order to figure that out, literally just Google FHA loan limits. It'll be like the first option. I'll drop a link in the description to this episode as well. You can check to see what the loan limits are in your local jurisdiction, county, etc. But if you're in a high cost of living area, for a single family property, the loan limit is $1,149,825. All the way up for a fourplex, it is $2,221,600. And I want to compare this to the conventional loan limits, because I always want you guys to weigh the pros and cons of each loan program. For a single family property, for a conventional loan, the 2024 loan limit is $766,500. So almost $300,000 more than the limit for an FHA loan, going all the way up to $1,474,000 for a fourplex. Once again, that's almost $600,000 or more than $600,000 than a fourplex with a conventional loan. So just some food for thought when you're weighing like, hey, can I go FHA or conventional? You may want to factor those loan limits in to consideration as well. It's important to note these are the loan limits, not the purchase prices. Let's say, for instance, you're looking at a home that is $516,328.50, a very precise price on a property. Well, after 3.5% down, that will give you a loan amount of, can you guess it? $498,257. So you'd fall within that loan amount. But what if you're looking at a property that is $520,000? Because that at 3.5% down will give you a loan amount of $501,800. So now you're above that loan limit. What to do? Well, you got to come out of the pocket at the extra $3,500 and change. There's no exception to that rule, because once again, the FHA sets the guidelines, so a lender cannot just overlook that and be like, oh, they're close enough, because these are insured by the FHA. But let's say you're looking at it, you're like, man, I can't pull off that extra $3,500. There is something called seller concessions, and seller concessions are a percentage of the home price that the seller can give to you to help cover the closing costs. With an FHA loan, the max seller concession is 6% of the purchase price. So if you're looking at a $100,000 home, the seller can help you with $6,000 towards those closing costs. And here's the thing, that's money obviously directly out of the seller's pocket. So you can ask for 6%, but to be honest with you, that will make your offer less attractive, because they were getting $200,000 from the sale of the home. Now if they're giving you $6,000, they're going to only get $194,000 from the proceeds of the home. So that's something that sellers look at too when factoring in your offer, especially if it's the exact same, except for you're asking for 6% concessions and maybe the other person asking for 2%, 1%, or of course 0 being the best in the seller's eyes. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. Debt to income ratio. There's a front end debt to income ratio, or DTI, which is your future mortgage payment divided by your income before taxes. Then there's the back end, which factors in everything, which is your future mortgage payment plus your monthly finance debts, like minimum payments. We're talking like car payments, student loans, even if in deferment, minimum credit card payments, etc., divided by your income before taxes. That front end can go all the way up to 47%, and the back end all the way up to 57%. But don't hold your breath for either of those working for most lenders. As I mentioned, there are lender overlays. So for the most part, lenders are going to see you at a 43% DTI. But if you're above that, you can potentially shop around and find a lender that can help you with a higher debt to income ratio. But I would think in my mind, like, hey, why do I have such a high debt to income ratio? Because once again, that number is before taxes and it's just your finance debt. So if you have like a 57% back end DTI, your real life DTI may be like 80, 90, or 100 plus percent. So you're probably going to be like house poor. But hey, do what you want to do. But just food for thought from my end, you do the dishes, right? But let's talk about if you're in a community property state, because you're probably just factoring in only your debts. And you're like, hey, I got good credit, but my spouse, she has bad, he or she, but I'm a guy, I'm going to say she has bad credit, so I'm not going to have her on the loan. Here's the thing, the FHA doesn't care. They're going to factor in your spouse's debts into your debt to income ratio. But since she doesn't have the credit to qualify, the income stays outside of the loan, right? So it's the worst of both worlds. You get to add her debts, but you don't bring her income to cancel those out. So that's something you want to factor in as well if you're in a community property state. And how do you know if you're in a community property state? Well, ladies and gentlemen, that is what Google's for. JK, let's break down these community property states. We got Arizona, California, Idaho, Indiana. I don't know. You got to figure that one out. I'll clarify it on YouTube, but you'll have to Google whatever ID. You would know if you're in what the initials are if you're in either Indiana or Idaho. So you know that, right? Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So, ladies and gentlemen, pay attention to your spouse's debts, and well, probably help them get above that threshold as well, so they can help contribute their income to the loan. Speaking of debts, let's talk everyone's favorite debt, student loan debt. What happens in that situation? Well, if you're paying your student loans, the lender just uses whatever the minimum payment is, and that'll be listed on your credit report. Now, what if your loans are in deferment and you got a 0 in the credit report? Well, the lender knows you're going to be paying the piper at some point in time, unless student loans get canceled. I don't know if that thing still going on, but if you're showing like a balance on your credit report, but they're in deferment, so there's a 0 payment. Unfortunately for you, the lender is going to use 0.5% of the loan amount, which can be a very, very hefty number, and most likely is a lot more than your payment would be if it was out of deferment. So for instance, let's say your total student loan debts that are in deferment is $100,000. Your lender is using 0.5% or $500 towards your debt to income ratio. Well, in actuality, like when they come out of deferment, it may be like, especially if it's like an income-based payment plan, it may be $100, $200. So I'm not saying take them out of deferment by any stretch of the imagination, but that's something to consider when you're applying for a loan, is what the deferred payment would be in real life versus that 0.5%, which may impede your ability to purchase a home. Let's talk appraisals. The appraisal is an independent, non-biased assessment of the value of the home. It's independent, being that the appraisal has no allegiance to the buyer or the seller, just to whatever they view that a home price is. Unbiased. I always kind of laugh at that because everyone has inherent biases, no matter how straight down the line they like to be. But here's the thing. So the appraiser is just appraising the value of the property, but they have eyes. So like they see what are like safety issues or structural issues with the property, they will flag them on the appraisal report. So for instance, foundation issues, like that's a big thing. If they see cracks in the foundation or issues with the roof, they will flag the, and this is for any loan, FHA, conventional, etc. They will flag those and flag the appraisal as incomplete and require you to get a subject matter expert, like a roofing expert or a structural engineer out there to see whether that property does have damage as well. And that's for all loans. But the FHA loan has some other more stricter requirements, such as like the roof must have like a life of at least 2 years left on the property. There can be no standing water outside the house. And the reason for that is if water is standing or sloping towards the property, it can mess with the foundation. So you may have to like regradiate or help with the gradient on the property. All the appliances have to work. And once again, another thing with there can be like there have to be like handrails on, I think if there's more than 3 steps in the property, all electrical outlets have to be covered. Stuff that should be done, but these are like sometimes like minor things that the seller may not want to mess around with. So if they're looking at like a conventional loan versus an FHA loan, exact same offer, they're like, hey, I don't want to have to deal with these minor things or, get a contract out here to do these small fixes. Hey, I just don't want to deal with the FHA loan. I'll go with the conventional loan. And also another thing is with a conventional loan, with an FHA loan, the appraisal stays with the property for the next 6 months. So let's say you're looking at a property, FHA loan, you put in an offer, for whatever reason you decide to back out of the loan. And it comes in it's a $300,000 home. The appraisal comes in at $295,000. Well, when the next person goes to make an offer on the home, if they're using an FHA loan as well, they don't got to order an appraisal because that appraisal is attached to the property at $295,000. So now that greatly hampers the seller's negotiating power, especially if we're in a market like we were in the early 2020, 2021s, where it seemed like home prices were going up like every single month, where a home that was $300,000 in February may be $315,000 like in March. So that's looked at as a negative from a appraisal standpoint with the FHA loan. Another reason that is important is there's something called the amendatory clause. What it states is that if at any point in the loan process, even after the option period, which is the time frame you have to inspect the property and still get your earnest money back, typically like 5 to 7 days, depending on the market, you lose the option money, but you can get your earnest money back during that time frame. But even after the option period, if the appraisal comes in less than the sales price, the buyer can still get their earnest money back. So let's say, same scenario, the home is listed at $300,000. Appraisal comes in, I've seen this at $299,500. Only $500, but still under the appraisal, under the list price. Now the seller or the buyer has all the leverage in the world. So maybe this thing you were going back and forth about, hey, should I get it fixed or not, or this or that, the buyer can be like, well, if you don't want to fix this issue with the leaking faucet in the kitchen, I'll just back out of the loan and walk away. I'll get my earnest money back. Now you got to put that property back on the market for at least another 30 days. Even if somebody comes in the next day, make a whole another mortgage payment. And also, don't forget that appraisal is attached to the property. So I know you got to list it for $300,000, but now you got to take, $299,500 anyway. So I got all the leverage in the world. So just, hey, let's just make those repairs and not make it an issue. And also, you got to disclose that issue with the faucet anyways, because I found it out during the inspection. So you got all the leverage in the world. And then there's like bigger gaps if you're thinking like a $300K home, the appraisal comes in at $290,000. Like now you have even more leverage. And so when we talk about seller perception, that's one of the reasons that a lot of times realtors will steer their clients away from FHA offers if they're the exact equivalent offer. Another thing, like I talked about at the beginning with the FHA loan, is more forgiving credit-wise. So sometimes sellers will be like, hey, well, this person is submitting an offer with an FHA loan. They have bad credit, which means they're financially irresponsible, which means that they may not be as responsible as a conventional loan person. And I only care about that because I'm trying to sell my house, man. So if they're less likely to close on the loan, I'm going to take the conventional offer. So Just FYI, I mean, that's why a lot of times you may see your FHA offer not accepted. But that's some negative things. Let's talk about some cool hacks with the FHA loan. One of the cool items is the FHA 203K loan or the rehab loan. So we talked about before like some deal breakers like foundation and roof. Well, with the FHA 203K rehab loan, you can refinance or you can finance all those renovation costs into the loan. And that's really, really to your favor because, as I mentioned, like foundation roof, that's a deal breaker for any type of finance loan. And so those typically go to buyers that are paying cash. But since you're able to put that renovation into the loan, now you can finance the maybe the $10,000-$15,000 it would take to repair the foundation into the loan. You can do cool stuff, cosmetic stuff too, like maybe upgrade the kitchen and do things of that nature, make the bathroom look all nice. So basically, you can buy like the ugliest home on the block and turn it into the jewel or the house of your dreams with the FHA 203K loan. Now, there's two versions of it. There's a like a baby loan and a bigger loan. Kind of like the demarcation point is if the repairs are going to be at least $35,000. Because at $35,000 and above, you have what's called a HUD consultant, which actually who's in charge of like making sure you're not getting like okey doke. They're like, okay, we're going to keep an eye on the contractors, etc. But I would say you got to keep an eye on the HUD consultant as well. I have a episode way back with a gentleman about him using the FHA 203K loan, and his HUD consultant was garbage. He actually was out of pocket $50,000. So no matter who's observing the process, make sure you're doing your due diligence as well on the observer, or maybe you get an observer for the observer too. Another cool thing you can do with the FHA loan is you can actually buy a mixed use property as long as 51% of the property is residential. You can buy like a mixed use property. So I always think like in New York, you see like the bodegas at the bottom and like the residences up top. As long as it's 4 units or less, that is fair game for you. So that's great if you're like if you just want to earn a little bit of revenue by having a commercial business under you, but maybe you can use it as an event space. Maybe you got like a barbershop or a salon or some sort of business you can have like literally right under your residence. So that's something I did not realize until like 3 or 4 years as a lender. So I was like, that's a pretty cool hack as well. Something I probably would have considered when I was buying my first property. Now, speaking of multi-unit properties, let's talk house hacking. Everyone likes to say, buy that 4-unit property, kick your feet up, live rent free. That is very, very beneficial if you can find a 4-unit property in the first place, because there is something called the FHA self-sufficiency test, which all FHA loans have to pass. What it says is that your mortgage payment cannot be more than 75% of the rent on the units, and that's for a 3 or 4 unit property. So let's look at a scenario. You have a unit that's $500, a unit that gets $1,500, and then 2 other units that get $1,000 a piece. That comes out to $4,000 between all the units. It doesn't matter which one you're in, but your mortgage should be no more than $3,000. So what happens if your mortgage is $3,001? Well, once again, this is an FHA guideline, not your lenders. They can't make an exception. You will not be able to qualify for the loan, even if you got an 850 credit score and your DTI is 1%. Of course, in that scenario, you would just put a little bit more towards the down payment to get the mortgage payment down. But it's something to factor in, especially in the environment we are now, where rates are high and home prices are at all-time highs. Home prices are at all-time highs every year. But you may be in a position where the property does not pass the FHA self-sufficiency test. It's also very important to note in high cost living areas like your LAs, your New Yorks, it may be hard to qualify for a loan with the FHA self-sufficiency test. So that's something you want to really look at before you even start looking for homes in the first place. Because you don't want to fall in love with a property and then go into contract for earnest money down and all this and find out, hey, this never was not even close to passing. And also, I like to point out that if you notice, the word self-sufficiency is in the FHA self-sufficiency test, meaning that in a 4-unit property, 3 of the units have to pay for the 4th. So that's whether the other 3 units basically cancel out the mortgage for you, or maybe you're in one of the units and then somebody moves out so you don't have your renter. So that's a great plan in place. But if you note, If three of the units have to pay for the fourth, that means if there's four people occupying the property would cash flow at least on paper. We're not factoring in any expenses or anything like that. Why is that important? Well, why in the world would somebody be selling you a 4 unit property that is actually like cash flowing and making all this money? So finding these cash flowing 4 unit properties without any issues are a lot harder than folks like to point out on the internet. Now, if you can still hear the sound of my voice, drop a smiley face or whatever emoji you think is appropriate for what you learned or maybe not learned so far. If you're listening to the podcast, leave a review. Let me know what you think. But as always, buy land. Rumor has it they're not making any more of it.